Like your team, choose your banking partner wisely. MUFG, one of the largest global financial groups, can support your organization's treasury, trust, and trade finance needs. Backed by a 360-year history and a commitment to innovation and long-term client relationships, MUFG can help optimize your working capital and provide best-in-class asset servicing solutions. MUFG Union Bank is the proud sponsor of the AFP Pinnacle Awards, recognizing excellence in treasury and finance, and also the sponsor of the AFP Payment Guides. Learn more at mufgamericas.com. That's mufgamericas.com.
My name's Andrew Deichler. I'm the Multimedia Content Manager for AFP. And today we're going to talk about liquidity management and where it needs to go. What are some of the key considerations for managing current liquidity structures? This episode of AFP Conversations will answer that question and more. I'm joined today by Olu Adebiy, Managing Director, Head of Transaction Banking Liquidity for MUFG, Glisson Inguito, Cash Management Manager and Head of Treasury and Cash Operations for Konica Minolta, and Amanda Schreiber, Head of Treasury for ICU Medical. Everyone, welcome to the podcast.
Thank you.
Thank you.
So, as I said earlier, we're going to talk about where liquidity management is heading, or it needs to head. What are the key considerations for managing current global and multi-bank liquidity structures? Olu, why don't we start with you?
Okay. So I think the first thing that corporates need to consider would be the buy-in from their global partners and global entities as well. It's a mixture of having the right sets of incentives as well as rewards for good participation in global liquidity structures, but also making sure that there is good visibility. I think visibility is absolutely key for any group treasurer or any group cash manager to ensure that they have a strong grasp of what's available, for what purpose, and at what time.
Yeah, I agree. I mean, having visibility into worldwide balances is key. With us, we have Europe, and so I try to manage that with the negative rates. The APAC region, just trying to get money back to the U.S. as efficiently as possible is key for us.
For us at Konica Minolta, we consider the tax laws within each local country, specifically BEPS or base erosion and profit sharing. We look at withholding tax on intercompany debt, but the primary is visibility for globally, especially for our head office in Japan.
You're both obviously global companies. I mean, regarding all that, what would you say then is your biggest challenge? Is it visibility or is it something else?
I think it is visibility in some regions because locally they don't want to have a global bank or they can't have a global bank, and depending on who the partners are, in that sense, it can be difficult to get their buy-in on that. And some regions prefer older, slower methods of payment that still don't give us a lot of visibility into that piece, or we're going with a local bank and then transferring to more of a global bank. And that's a multi-step process to get money back in, which slows it down. And with that's especially Latin America for us, and those currencies are very volatile. And so just within a week, you could have something like Argentina where you can't have that delay with, say, 120-day DSO from a dollar-based product to local currency to collection and then back up to the parent. It's extremely difficult.
I agree there too. For us, it's the local currencies, of course, affect, because of the foreign exchange component to that, the risk involved and volatility of the local currency against the US dollar. So we try to really have a symmetrical global kind of pooling arrangement with a major bank currently that allows us on a regional basis to be able to manage our cash globally in a sense, so that as minimal cash is outstanding and unused by our regions to benefit, of course, our corporate office in Japan.
The 2019 AFP Liquidity Survey found that 93% of Treasury and finance professionals consider their overall relationship with their banks to be a detriment, determinant when deciding where to place their organization's cash and short-term investments. Obviously, it's an important factor, but for each of you, would you say it's the most important factor for your organizations when you're determining where to put your operating cash?
Yeah, I think, with different like credit facilities and banks involved and the relationships there, it's extremely important to have that. And then, it's multiple products along that go in a portal, and it's easier to have visibility into all of the product lines that are with your relationship bank than to go up, and I guess looking for yield is not as easy now. It's not going to be a huge difference between banks, so it's better to go with the relationship.
Right. I agree there. Reciprocity is very important to Konica Minolta with its relationship banks, or with the global facility that we maintain. We have, of course, regional facilities with other banks as well. So we take that into consideration, the overall relationship with the low interest rate environment pretty much everywhere. And even if it moves like it has been moving, and then the last two rate cuts, strategically, we don't see a benefit in moving money to money funds if necessary, or even for ultra short-term bonds beyond an extended period of time. So concentrating cash at our relationship banks allows us to obviously preserve our principal as well as pay for earnings credit on our fees, which is very important for us to offset, as well as to manage our cash as seamless as possible.
Well, you mentioned money funds, and that kind of was my next question, because the survey also showed that most financial professionals reported balances in stable NAV funds, but some respondents did indicate renewed interest in prime funds. Is that something either of you are considering, or something your organization might consider in the future?
No, I think for us, we're getting enough a great rate on our relationship deposits that we have, and those are overnight, or having it in an operating account where it's readily available in case of a large payment or anything that comes through. It's a low rate environment. It's easier to keep it simple. Sure. Right now.
And I think for us, at least in the U.S., as we are a net borrower, it's more important for us to maintain a liquidity and visibility to our cash rather than investing for a very incremental yield. With the volatility involved in NAV because of the 2a-7 rule, it doesn't create any benefit to move into the prime funds in order to get an incremental yield from money funds. And so, I mean, deposits basically generate the same amount for us. I mean, and that's pretty much how we factor in the consideration of different funds out there.
Olu, is that what you're seeing as well?
I think so. I think funds remain an important part of the overall product set for corporate clients, and we're definitely seeing that coming through. But to try and address this question and your previous one around banks and their relevance or importance there, what we are seeing and hearing more from our clients is greater appetite for deposits from banks. I think part of that is due to regulation. I think now banks are heavily incentivized, or required probably is a better way of expressing it, to have more customer deposits to support lending and our customer lending businesses. And so clients that we're talking to understand this requirement and appreciate that requirement, because the lending relationship is an anchor typically in how these relationships are established in the first place. And so when you put that with greater demand for on-balance sheet deposits, greater pricing capabilities from the banks, we're seeing that clients are very inclined to keep their deposits with the banks, which is supporting the growth in bank deposits. However, we can't deny that the money funds in a rising rate environment do provide an attractive option, and so clients are very much managing between the two. and there's a place in any investment policy for both, I think.
Sure, sure. The environment's still pretty uncertain. We see that with our corporate cash indicators that we do every quarter, showing that most corporations are kind of just holding on to money. Maybe they're building cash, or they're not doing a lot of investments. They're kind of like keeping it because there's a lot of talk that a recession could be coming. Maybe a big one, maybe a small one, but one way or the other, a lot of organizations are. They want to keep that money in those deposits. I mean, is that what you're observing as well? I mean, do you think that that's like not only the regulations, but that this uncertainty about the environment and we're not that far away from 2008. Do people, do you find that your clients are constantly like have that on their mind as well?
Yes, I do. I think a couple of years ago, on the onset of increasing interest rates, we did see clients who had significant balances move some of their non-operating balances into off-balance sheet instruments and some of their operating balances into interest-bearing type DDAs or hybrid structures. With rates stabilizing in the last 6 months, and actually with 2 cuts occurring in the last quarter or so, we are seeing clients start to reassess those decisions and start to suggest keeping and opting to keep more funds on their deposit accounts with us, and that's something that will continue to evolve as the interest rate environment evolves. But with the LIBOR curve, for example, inverting and the highest point on that curve really being in the short end, there's not a lot of opportunity there for placing longer term to actually drive yields, similar to what Amanda mentioned earlier on. And that's really changing a shift in thought processes and in decisions. But ultimately speaking, we are seeing bank deposits still have a very, very relevant and significant part of the overall party.
Yeah, I think also we expected, say, a little over a year ago, some more rate hikes, and now it's turned to cuts. Same with Europe. You almost expected a little bit of a hike, at least to 0% around this time or soon, and they're cutting again. And it's hard to plan a little bit farther out because a tweet could change something, or the global environment is driving a lot of these issues. And it's an overall picture too. You look at the rates, but you have to look at the weakening of the currencies and then try to gauge where, if one currency does go negative, do you convert if it's weaker to a stronger currency like the dollar? You lose on that part, but so you can't really go that far out in your forecast with that. The other piece is I don't want to place anything too far in advance because maybe we'll have a rate hike or Europe will turn around, but it seems like if there's a recession, I also don't want to tie up my funds either. And we're compared to the rest of the world, the deposits that we get for at least dollar on my side are a lot better than the other countries that we're in.
From our perspective, it's rate cuts or rate increases don't necessarily directly impact our business in terms of maintaining cash. The overall picture is, of course, to minimize cash at our office, enough under our pooling arrangement we have in the U.S., for example, and in Europe and in Asia, and pay down debt at the corporate level. That's more important overall. The visibility allows us to do that, and with the pooling arrangements and the partnerships we have with our banks.
In addition to those partnerships, I mean, are there any technology innovations that are helping you manage your liquidity positions?
Nothing new now. We're still trying to catch up to there are all these products offered, and it's really internal IT and that we need to catch up with. There's always a project, always an acquisition, always an integration, and some things take priority over that. I feel like some of the tools that were available a couple of years ago are still relevant to us now, and as long as we have visibility into our balances, what's going in and out, and can do the operations efficiently, then that's okay with us.
This conference here at the AFP Boston certainly enlightened me, and hopefully for our company going forward in terms of artificial intelligence for forecasting, cash forecasting. Some of our banks have already discussed providing data to us, which we also have in our SAP system, but we don't have it segmented properly, and it'll probably take us a lot of time. We have business intelligence reports, but they're mostly, I would say, more sales-driven. So for the finance department and specifically Treasury to able to get that information from our banks, who apparently can provide that as a product in the future, should help with our ability to forecast a lot accurately than we have been out to 13 weeks usually. We have a workstation right now that allows for the data aggregation. We're hoping in the future that in addition to our banks partnering with us for analytics will allow us to better forecast. And this is really a project that a pet peeve of mine is trying to improve our cash forecasting because that benefits overall globally our cash position.
Yeah, we've actually did a podcast earlier today where we talked with some of the speakers here about using AI for cash forecasting. It does seem to be where it's going. We even have a guide that we wrote recently that'll be, well, by the time this podcast airs, it will be out so people can take a look, because it seems like one of the hassles about cash forecasting is trying to have that accurate data to project out. I mean, like what you were just saying earlier was that, it's so difficult right now to project, like into the future because you don't know the rates, with the rates and everything being uncertain. But if you can kind of aggregate all that historical data with an AI solution, it may be able to, give you more accurate forecasts, So you are looking then into investing in that?
Yeah. Yes. I mean, it has been discussed in some of the discussions we have with our banks and with our Treasury workstation provider to upgrade our cash forecasting ability, not just variance analysis between forecast and actual, but predictive and analytics to be able to improve it. I mean, for us, volatility in the movement of cash outflows and inflows surely impact how much cash we maintain. We have a pooling arrangement that sweeps the money out and brings it back to our parent, but it's still inefficient, let's say, overall. It's not where we want to be. We need to be more accurate in our cash forecast because although liquidity can be same day out of money funds, out of the movement between Asia and the U.S. is not same day. I mean, it'll be next day basically from them if we need the cash.
Yeah, I mean, from our perspective, technology remains a very important cornerstone of being able to provide services to our clients, and so technology on the internal side is very important. Things that our clients may not be able to actually physically see, but we hope benefit from the experience. An example is us investing heavily in technology for our service organization to better improve our response times and to better equip our client service officers if they do receive a call from our clients, to better equipping them to address situations or queries in a very efficient manner, all the way down to what our clients do see. And so investing in channels, and again, just listening to Glisson talk about the forecasting aspect, that's something that we have also found as to be a requirement from our clients, and banks generally would like to support that. And so we've invested in our technology offering for them from a forecasting perspective for clients that may not have a TMS, and who would like their bank to be able to support them with their forecasting that they're able to put into the channel, or also rely on actual bank data. So it's not AI yet, because I think the industry is still grappling with how we can use the advancement in the broader technology environment, but it's making those significant steps there. And finally, It's about trying to bridge the gap between the technological advancements as a consumer, as an individual, and try to bridge that gap with the corporate space as well. So we all have smartphones, we can access our personal bank accounts on these smartphones, but what about moving some of the corporate experience in the form of mobile tokens or mobile banking into smartphones or tablets, and those are the areas that we're thinking of to just better enhance the experience for our clients.
Absolutely, yeah. So yeah, it sounds like in the current environment, like bank deposits are still the way to go with everything, in the current rate environment, and the technology, as we see here at the conference with all these sessions, interviews we've done, and with this interview too. I mean, everybody is looking to the future, whether they're adopting AI right now or not, and they seem to have their eye on it, particularly for cash forecasting. So I want to thank you all for joining us today. This has been a great conversation, and I want to encourage our listeners, if you're interested in more about liquidity, please download the 2019 AFP Liquidity Survey, and also if you're interested in more on AI and machine learning, please go ahead and check out the Emerging Technologies Executive Guide on that topic. And so again, thank you so much to the panel. It's been a great talk.
Thank you very much.
Thank you, Andrew.
Thank you for listening to this episode of AFP Conversations, brought to you by the Association for Financial Professionals. You can subscribe on the platform of your choice. We'd love to hear from you, so please leave a rating, review, and ideas for future podcasts. Thanks for listening.